Hello, everybody, and happy Tuesday. Welcome to the Like Tortoise channel, Tortoises. In today's video, we will break down Domino's Pizza, and I'm going to tell you exactly why I think this company is getting even more interesting as the days go by and as the stock becomes cheaper. As always, if you find this video insightful, please make sure you smash the like button because it really helps us grow. And thank you so much for continuing to spreading the words, because I know that based on some of the messages that I'm getting, that you guys are finding a lot of value in these videos, and that as you all already know, makes my day, because we really try to do things a bit different right here. We try to buy quality not at a reasonable price, but we try to buy quality with a big margin of safety. And Domino's is getting attractive. And unless you believe this company is just a garbage, which that is certainly not where my belief lies, then you may have an opportunity right here. Okay, awesome. So let's tell you everything. And by the way, the last video, guys, was 1 hour and 50 minutes. It was a full deep dive into Kelly Partners Group. It was by far the longest video I ever recorded for my YouTube channel. And but anyway, I just distilled everything there. So if you are interested in the company and in looking in getting a bit more familiar with my investment process, then just watch that video, because I think it's very insightful. Okay, guys, so I haven't created the full investment case on Domino's yet, and so I will do things a bit differently right now. Just to make this video a bit shorter, I will walk you through valuation, but then I also want to discuss the investment, so the business model, how the company makes money, and why I think the business is very attractive. So a very good starting point for those of you who are new to the channel. I will walk you through I'll walk you through this in simple terms, so you don't have, because this way you won't have to find a lot of time digging around. And one of the things that I like to do, so let me go right here. You can just type in Domino's Pizza, and then you put, if you come here, Domino's Pizza Investor Relations, then you can come right here to their website, and you will see straight away, oh my God, I had one of the pizzas about like 3 or 4 days ago. I had it with my girlfriend, and man, it was so tasty. I'm not into junk food, as you guys know. Well, if you don't know, then you know it right now. I'm very health conscious. I like going to the gym 5 days a week, but yeah, I keep my health in check. But whenever I have a cheat meal, Domino's is one of those foods that I love their pizzas. I think they are so much better than competition, and that tells you something. But okay, so anyway, let's go back right here, because we want to talk financials. And so if you come here to results, reports, and presentations, then this is where you can see the 2025 annual report. You can download it to read more about the company. But more recently, they also shared the quarterly reports, and the stock fell sharply after that. And I think it was on the back of soft guidance. Analysts were expecting stronger guidance, and instead they disappointed. And yeah, so this is where you can get that information. Okay, so I hope that makes sense. But an even faster way to get a quick idea of whether or not this company is worth your time, then you can just type in Domino's Pizza, and you just type in Domino's Pizza investment case. And what you can see is you will find a ton of investment cases already written on the company, and some of them are quite updated. So one of the things that I like to do is, for example, I like to type in Domino's Pizza investment case Substack, and then you will see a lot of authors, articles by authors, articles on this company. For example, we have this one here, Substack Bebop Value. This was written 7 months ago. Let's see if I have access to this article for free. And you do that, right? Yeah, I'm scrolling down. Okay, continue. So you have to continue reading this post. This is for free. You're going to have to subscribe. But still, what you can see is that this part of this article already breaks down already breaks down how they make money, potentially the geographic split, the revenue split, and you can read about this right here. And one of the things that I like quite a bit about Domino's is that this may surprise you, but they are actually a technology company. They invest a ton of money in technology, and I wanted to show you that to you. But another easy way that you can then you can dig further. Look at another Substack updated 2025. What happens is the initial write-up. Yeah, so this is also paid contribution, so we don't want that. Let's see, this was written 6 months ago. I also have access to a lot of free information right here. Let's see if they have they mention anything about technology. No. Okay, that's totally fine. But this report right here is complete. Well, actually, it's not. Continue reading this post for free, courtesy of Michael. But yeah, you can see that you have a lot of access to a lot of free information, and you can start building a conviction just in an easy manner. I hope that makes sense. And another way is you can just come here to ChatGPT, and I will show you exactly what I like to do. You can just come here and you can type in, for example, I don't know, let me see, for example, I did right here for Kelly Partners revenue breakdown. You can do the same. So, for example, breakdown Domino's Pizza business model, and how they, the business model, how they make money. So I want the revenue split, revenue and geographic split. And I use a lot of that information as well to build my investment cases on top of all the research that I do across, because I always analyze the annual reports, the quarterly reports, the conference calls, Substack newsletters. But you can see, look at this. Business model, franchise royalties and fees. This is very, very good. One of the reasons that attracted me to Domino's in the first place was this exact thing that I wanted to share with you guys. They are, so the majority of Domino's stores are franchised. This means that they collect royalties. They are a royalty company. They get a fee, which means that they are very capital light. So I love the business model, and it's very easy for them to scale because they have the brand reputation. They have a ton of things that franchisees would like to model, and that's exactly why they pay Domino's that fee. How it works: franchisees operate Domino's branded stores independently. Domino's earns royalty fees based on franchise sales. Why this is attractive? Highly asset light, strong recurring revenue. As you already know, I love recurring revenue. Is the most powerful type of revenue. Limited operational risk, because if those businesses struggle, then because it's not, the stores are not Domino's, right? They don't have as much operational risks they otherwise would if they were buying stores outright. High returns on capital, that has been the case for Domino's. And then you have supply chain operations, and all of that. Company-owned stores, it's a small percentage, but still they do own their own stores. And then you can see the geographic revenue split. What I like about this as well is that they are still 55, 60%. They still generate over half their revenues in the United States, but their exposure, their international exposure is becoming more relevant over the last few years. And I like that as well, not least because I believe international markets will continue to outperform over time. And you can see they already operate in over 90 countries worldwide. Look at the geographic operating nature: United States, international. So you can find a lot of data right here, but then you always need to corroborate what you see right here with data-driven research. And there is no better way to do that than by going directly to their website. and read the annual report where they discuss the business model at length together with the risks the management assessment of the environment. Okay, so this is pretty cool, and you can see why Domino's has been on my radar, but not because the stock is becoming cheaper. Because if you remember, and you can just go back a few videos, and I think it was around January this year that I put out a video telling you exactly which stocks were on my watch list that I'm keeping a close eye on in 2026. Domino's was definitely one of them. At the time, the company was still trading at about $450 a share. And fast forward a few months, look where we are right now at $311 a share. So the question is, has the moat been disrupted? Is the company no longer attractive? Is the price getting cheaper for a good reason? This is what I want to discuss. And so let's have a look at Domino's financials right here. You can see that Stock and Lock gives them a 3.78 out of 5 score, which is very, very good. In addition, let's go here to the income statement. Let's go to the total revenues. Look at this consistency, everybody. You guys know that I love consistency in the numbers and predictability, because this, it makes our lives so much easier. And you can see that since 2013, they have been compounding revenues at 8.57%, which is very, very good. In addition, if you watch the operating income, take a look at that. Fantastic, right? Compounding faster, which means the company continues to gain operating leverage. And in fact, if I show you the margins, let's have a look at their margins. Take a look. This is the growth margin, as you can see right here. Look how growth margin has been improving since the recent lows of 36.34 in 2023. So it's going up possibly due to, even against the backdrop of supply chain disruptions and so forth. And if you look at the operating margin, look at this operating leverage. They are controlling costs while still growing. This is fantastic. I mean, this is exactly, not every company can do that. And so you look at the free cash flow margin, again, exactly because they are very capital light. So the average since 2013 is 61. I mean, can you believe that? Excuse me. So the average is 10.11, and the latest is about 13.14%. Again, the consistency in the numbers, and this has been upticking, which is also very good to see. At the time, the company continues to face more selling pressure. If we go here to the earnings, look at this beautiful, beautiful right here, everybody. Earnings growing faster than revenues, 12.45%. And then because they are famously, they buy back their shares aggressively, I assume that the earnings per share is even growing faster. So let's have a look at the diluted earnings per share. My goodness, take a look at that. 17.32% annualized since 2013. Staggering. And it goes to show that we are in the face of what we call a cannibal stock. Since 2013, they have reduced the share count by a staggering 41%. So these are the type of companies that I absolutely love. And let's have a look at their balance sheet right here. And let's take a look at one of the things that I never really liked with Domino's is the fact that they always operated with negative shareholder equity. And you have to understand the business to understand that. The reason for that is because they buy back a ton of stock. And it's just what it is. And so what happens is, take a look at that. They use a lot of the cash to buy back a lot of stock, and what that does is it makes it so that the cash, which is a current assets, decline, and that makes the total liabilities relative to total assets larger, which of course depresses the shareholder equity or the book value. However, this is not uncommon among great companies, and Starbucks is another example of a company that operates in with a negative book value. Okay, but what you can see as well, let me go back right here to our stock analysis tool. Let's flip this to Domino's DPZ. Let's go here to statistics. I want to show you something. And so they have about $4.90 billion in debt, which is a lot, but they generate, remember, recurring free cash flows. They generate about 657 million in free cash flows. And what you have right here is that they can pay. Let's have a look at the debt levels. Where is this? Right here. So the debt as a relative to free cash flow is 7.88. This is definitely a more leveraged balance sheet. If you are new to the channel, then you know that I like to invest in companies that can pay down all of their debt within 3 years of free cash flows. That is not the case right here. But what I also know, if I go here to the free cash flow statement, to the cash flow statement, the free cash flow is also at all-time highs. Let's change this to the trailing 12 months. Look at that, near all-time highs. So they are a money printing machine, which is very, very good. And you can see how much money they spend buying back stock. Take a look at this. Net common stock issued. They use a lot of that free cash flow to buy back shares and also to pay dividends. Look at dividends. Okay, dividends paid, net common stock issued. And they also use a lot of that to repay that. So it's very predictable, and because they are capital light, they don't need to do a lot of reinvestments. So take a look at the investments print, investments in property, plant, and equipment. This has been going up. However, right now it's still at 120 million. It's going up, which is depleting free cash flow as well. And that is part of the reason why the debt to free cash flow appears higher right here. But the predictability of the free cash flows, the consistency makes this understanding. And for example, Warren Buffett, I'm not sure if it was Buffett who decided to make that decision, but I know that Berkshire Hathaway bought Domino's Pizza not that long ago. And that tells you something. So they do see the competitive advantage of the company. And look at these returns on invested capital, everybody. I mean, seriously, let's have a look at the returns on capital over the last 5 years. So let's have a look at ratios right here and take a look at ROIs. It's actually going up. Unbelievable. 56.55% in 2023. Right now we are at 71.40%, which is staggering. Take a look at ROS. It came back down sharply. So we have to understand why this is, what caused that decline, but it has to do for sure. So yeah, here we go. It has to do with the EBIT, either EBIT decline or the total or the denominator increased faster than the denominator, in which case we see the ROS coming down. So we have to delve deeper into that. ROS, so the return on assets is going up, right? So how efficiently they use the asset base to generate profits. And then you can see the return on equity, which is negative because book value is negative. Okay, so very nice to see. The current ratio sits at 1.60, which means they have enough current assets to cover all the current liabilities. That is good to see. The only thing, it's still a leveraged balance sheet. I want to make that clear. And you can see, for example, the interest coverage, the interest expense. So if we come here, you can see that the interest expense, it's a big part of the free cash flow, as a matter of fact, because they have a leveraged balance sheet. So it's 196 million right here. it's been stable, and I actually expect it to decline with declining interest rates. But what that does, when you do EBIT divided by interest expense, you will get the interest coverage, which in the case of Domino's is 4.92. Ideally, I would like to see this at or above 8, as you guys know, but still a 4.99 for a company of this caliber is, I mean, it's okay. And again, you have to understand and get comfortable with the financial position of the company. And it's nice if you can read more from management about what they are doing, if anything, to deleverage the balance sheet. So I hope that makes sense. And take a look at the weighted average cost of capital, 5.59, while the ROI sits at 78.83. So the economic spread is staggering. Look at these margins again. So operating margin, look at the free cash flow margin, right? Even greater than profit margin, which is very, very cool. Very profitable business. I love that. In addition, you have a free cash flow yield above the 10-year rate. So it gives you a yield of 6.28%, which is higher than many banks are giving you. Same thing for the earnings yield. And because they do buybacks, so you have, excuse me, you have a shareholder yield of 4.80. Okay. And so, yeah, I hope that this makes sense to you guys. And now I want to show you another thing, and that is, in fact, and I'm doing this analysis right here, or like with you. So I hadn't looked at Domino's Pizza before. I mean, I looked at the company before, but not in preparation for this video. And so, for example, I don't know if insiders are buying or selling shares. I can see the insider transaction right here. So we can see the executive vice president, CTO, selling shares right here. And let's have a look. Oh, wow. Look at this wave of selling. A lot of selling right here. Only one reason why they buy, but there are plenty of reasons why they would sell, but there's a lot of selling right here, guys. It's not ideal, but again, you can make the case that has always been the case since forever, right? I mean, look at this wave of selling right here. I see a lot of selling and no buying, which explains why the insider ownership is so low. Let's flip this to the ownership. Can I do that? So show only company executives. Yes, so the CEO and director has about $12.46 million worth of stock. And it will be nice to actually see the compensation package and see how this guy is rewarded. But what I really like about the CEO is that he has been with Domino's forever. So yeah, and he really climbed up the ladder, which is very, very good because he knows the company inside out. Hope that makes sense. And now let's discuss valuation and what analysts are projecting going forward. I checked Fiscal AI, and I can see that analysts are projecting long-term EPS growth of about 11%. And if I go right here to my intrinsic value calculation template, you can see that I used Phil Town's 3 valuation methods to compile, right? So to arrive at the intrinsic value. And guys, if you want to know more about these 3 methods, just go back to my previous videos because I discussed them at length. Starting with the margin of safety, which is only best suited for companies that are growing faster, like a Netflix, a Microsoft, otherwise the number that you will get is very, very low. And look what happens. That is exactly the case with Domino. So the company currently trades at $313 a share, and you have a margin of safety entry price of 133. This is very low, and it's because we are using 11% growth rate, which gives them a default PE of 22, and that depresses the margin of safety. Okay, so the best methods in this case are the payback time and the 10 cap rate. And look how beautiful this is. Using payback time, for those of you who are new to the channel, payback time tells you how long it takes to get your money out of the business from free cash flows if you bought the entire company today. And we want to recoup our investment in no longer than 8 years, which is about half the average of an S&P 500 company. So all these methods have a 50% margin of safety built in. Take a look at that. Let's grow free cash flows at 11% per year for 8 years. And then you sum all the cash flows and divide by the number of outstanding shares, and you get the free cash flow 8-year payback time price of $253 a share. Right now, the stock is at 313, so it doesn't quite meet that margin of safety criteria, because this means that our payback time will probably happen somewhere in the 10th, between the 10th and 11th year. Let's find that. Let me do this. Okay, and now what I do is I take this cumulative free cash flows, divide by the number of outstanding shares, and you get 312. Boom. So at these prices, it will take you about 10 years to get your money out of the company from free cash flows if you bought the entire company today. You want this to be 8 or lower. But what that means is that the intrinsic value of the company is 253 times 2, right? Because this is 50% off. So the stock, the real value, the intrinsic value according to this method is $500 a share, which means you already have a very good margin of safety at this level. And then my preferred method is the 10 cap rate, because it assumes no growth assumptions. You start with operating cash flow, you deduct the maintenance capex, you add the tax provision, and you are left with total owner earnings, which is what Warren Buffett likes to use when analyzing a company. And if you divide that by the number of outstanding shares, you get 25.20, and then you multiply that by 10 right here, and that gives you 252. What does that mean, ladies and gentlemen? I have it right here. This was adapted from real estate, and a 10% cap rate means the business generates a 10% pre-tax cash yield. In other words, you are earning 10% on your money and would recoup your entire investment in about 10 years, even if the business never grows. This is fantastic. Okay? Fantastic. And this is what we want. Same thing right here. So the intrinsic value of Domino's Pizza, per my conservative assumptions, lands at about $500 a share, which is substantially higher than where we are right now. As you can see, we are at $314 a share, and the 50% margin of safety means that I would be more than glad to buy shares in this great business at about 250. Because I know the company and I've been doing this for a while, anything between 280 and 250 is very good, if you ask me. Okay, so just to let you guys know exactly that Domino's is also on my radar, and I will keep you posted if I do end up making an investment decision here. Not financial advice. Always consult your own financial advisor and make your own due diligence. That said, everybody, I do hope that you like this. Just let me know in the comments below if that is the case, and looking forward to hearing from you soon. Thank you, everybody, for tuning in once again. Let's make money the tortoise way.